we are expecting the market PMI to come out shortly. And while we're waiting for that, look at an intraday of 10s. You can see that yields dropped. They dropped on all the treasuries as the futures markets opened in Chicago at 820, a little loftier in yield, a little heavier in price overseas. And if you open the chart up to 2 weeks, you could really see that once we popped up over 160, we have firmed up a bit. So you want to mentally use that level like traders are as a pivotal area. And if you look at bond yields, one of the reasons we've been propelled higher, their 2-week chart, it's evident. They closed at minus 20. They've traded as high as minus 16 today. And if you open the chart up and go all the way back to January of 2020, you can clearly see that this is the highest post-COVID yield, the lowest price, and the April final for markets manufacturing PMI is hitting the wires at 60.5. We're expecting a number a few tenths richer than that, but that is roughly as expected, and it does, of course, challenge this notion of the post-COVID high. So we replace 60.6 with 60.5. That is still a post-COVID high read for this metric. And, of course, we're going to have more PMIs coming up along with construction numbers. And finally, let's get back to those charts. If we look at the euro currency in the context that interest rates have moved higher, you're going to be a bit disappointed. Look at this 2-week chart. We've actually started coming down in the euro currency. It's down about €1 from the highs on Wednesday that were right around 121.5. Why? Well, it looks as though that the euro currency, especially post-ECB meeting, is where most of the pressure ended up. But now look at the handoff from the currency side to the interest rate side, as more and more now are saying that the stimulus in Europe, as vaccines start to get out there, is something that may have to be pulled back a bit.
Shepard Smith here. Thanks for watching CNBC on YouTube.